Welcome back to 15 Minutes of Finance. This is episode 17, the different types of advisors and how they impact your investments. So we're going to talk about a lot of different aspects of the industry, kind of a peek behind the scenes, if you will, a peek behind the curtain at the Wizard of Oz and who's actually the green man managing your money. And I think a lot of revelations in this episode will surprise our viewers. So I'm still figuring out elements of the financial industry as the CPA of our firm who's slowly integrating into the financial management side. It's surprising to me, a lot of things that I'm discovering the more and more I get integrated. And if you don't know intricately this industry, there are so many hidden fees, hidden parties, weird ways that your money is actually managed that you probably don't understand. And we'll use some anecdotes, not only personally, but also clients that we've worked with to see that it is often not a transparent experience learning who's actually managing your money, because little hint here for what you're going to learn in this episode, it's often not the person that you call your financial advisor. Often less than 50% of the time, actually, is your actual financial advisor the one managing your money. So there's two angles we can kind of talk about here, and so I'll let James talk about the first. And so there are only three ways that advisors get paid. That is one way that you can sort of look at the type of advisor you're working with, but we're also going to peek behind the curtain, and we're going to talk about really four categories that we're going to break it down into in terms of the actual capacity of management that your advisor works in and how those different options impact your money. So James, talk about the different way that your advisor is paid from managing your investments and how that kind of impacts what their involvement is.
Yeah, absolutely. So this is like very clear for me, as you know, I wouldn't quite say I'm not a 50-year professional by any means, but I am definitely, I've been in this industry for 10 years. So describing and seeing the intricacies of every hand that's involved is it's like a very vivid picture for me. And obviously for you guys, for Brandon, for anybody who's outside that bubble, it's hard, right? Like you guys kind of only see your advisor and you kind of think that's it, right? That is not the case. So when you're speaking with an advisor, it's quite possible there's, I would say, as much to up to 5 people you're paying. So what you'll see, though, is the 3 ways an advisor is paid, and this is how they'll describe it to you. So the first is a commissionable payment, which this is your life insurance, this is your broker-dealer advisor, your registered representative. All of these different terms really just mean upfront commissions. And then you also have your flat fee advisors. Now, I know a few of these tend to be, in my opinion, the most I want to say honorable, because they're separated by their fee. So what I mean by that is, if you have a fee only advisor, or a flat fee only advisor, you're writing a check to them. So it just would be like how you pay your CPA at the end of the year, or you pay someone to fix your vehicle, or anything you pretty much pay someone, a professional, for, you write a check for. That's what a flat fee means. So say it's $10,000. You pay $10,000 every year. Your advisor is going to look at your portfolio and they're going to give you recommendations, but they do not implement them. Okay. These people are not overseeing your account. This is for the people who do all the trading themselves. They're very hands-on. So I call them the engineer types. They want to know and do and be behind the wheel of everything with their investments. So that is the flat fee advisor. They're only giving you essentially a recommendation and an opinion, and you pay for it. Those people, those advisors, their fees tend to be between $5,000 and $10,000. They have no custody of assets. They have no discretion over the assets. All they're doing is saying, here's our opinion. This is how we'd do it if we were you. Okay. And then the other is how we get paid, which is the AUM fee, the assets under management fee. So this way is, if you have $100,000, and we'll just use 1% as an example, we are essentially the driver of the vehicle, and you own the vehicle, but we're driving. And in that, you're going to pay us a 1% fee. And the thought process there is, if you are driving a vehicle, or if you have someone else driving your vehicle, you want them to take care of it, right? You want them to keep it clean, keep the oil changed, keep air in the tires, make sure they don't do anything reckless on the highway, right? They're being mindful of what other vehicles on the highway are doing or other drivers are going to do to the car, right? There's all these things. And you essentially want a percentage in that scenario, right? You want your assets to do well, but you don't want to be driving the car. And the reason that you pay a percentage is because the better that account does, the better the advisor does, right? So 1% on 100,000 is $1,000. So the thought process is you want this account to grow, right? Well, you need an advisor who's invested, who's interested. That's what that 1% does, is that puts the advisor in on the same side of the table would be how you could describe it, right? You want someone who's on your team and does well if you do well. And that's where that percentage comes. So that's a deep dive into those 3 ways that an advisor typically gets paid. There really isn't any other way legally that I would say.
There's all sorts of ways advisors can get paid, but not under the letter of the law. So let's talk about the way these incentives can change investment strategies. Let's put it this way. There are protections in place that regulate all of these types of decisions. That doesn't mean that there aren't still perverse incentives, let's call them, that motivate each of these types of advisors. So we're going to talk about the capacities in which these types of advisors work. For example, someone who sells commissionable products, they're selling life insurance products. We can see right off the bat, they have a perverse incentive to sell you as high of a value of a policy as possible because it increases their commission. There are protections for selling bad policies for people. We'll talk about the different levels of fiduciary care versus suitability that exists, but obviously we can see that there's incentives that favor the advisor over the client, right? And we have the same thing. We have incentive to, someone who's an RIA who works under AUM. We want your account to grow. There's an incentive there. Now, again, we have a fiduciary responsibility. You have levels of accountability to get, recompense if we totally mess up your investments and put you in investments that aren't within your risk tolerance. But we have an incentive there to be in large growth. We want to see growth in your account because the higher your account, the more our fee is, right? We get a percentage of your account. Same thing with someone who works in a broker dealer. They're getting per sale. There's the broker dealer gets a part of that sale. They want to make as many trades as possible. That's their perverse incentive that regulations have tried to account for. So every advisor, it exists an incentive counter to the client's needs. And there's protections, there's rules, there's governing bodies to protect against these things negatively impacting you as the client. But it's important to at least be aware of how any structure that your advisor works under comes with it some sort of conflict of interest that could potentially be exploited by the advisor you're working with. We would say the most often exploited way to work with is the commission structure.
Yes.
And let's talk about just right off the bat something here. Do you know what an financial advisor is? Because here's the answer. Anybody. Anybody can call themselves a financial advisor. Is not a CPA. They aren't a CRPC. It is not a title that comes with a specific regulated set of tests, standards, work experience. Ethical expectations, right? So an insurance broker that does not manage investments, they are exclusively, the only thing they're even allowed to do is to sell an actual product from the insurance company they represent. They can call themselves a financial advisor. Okay, I'm going to talk now about a personal experience of how this is exploited, okay?
Buckle in, guys. Buckle in.
Buckle in, and if I start crying, I apologize. It might be the first time a grown man cries on 2 Gens 2 Cents. It won't be the last, but it might be the first.
Real quick, too, this story he's about to tell you, this was, I don't know, maybe 6 years ago. Brandon calls me, and Brandon and I have been friends for over 10 years now, but he came to me and was like, hey, I kind of got this thing going on. What's your opinion? And the story about you're about to hear, I had never heard of this before. So this was new for me, already being in the industry for 5 years. So, okay, take it away.
All right, so here is the number one difference between a suitable and a fiduciary advisor. So I talked to somebody who was a friend of mine from college, okay? So he reached out and was like, hey, I noticed you got a new job. Congratulations. Classic exploitative insurance salesman stuff. Hey, we should get together soon. Of course, the get together is just to set up a meeting so that he can sell me something. I didn't realize that at the time. They advocated themselves as a full service we introduce assets, there's mutual funds, there's insurance, there's all these different things that we incorporate. We don't just do one thing for clients. So they kind of tried to immediately hedge against my initial skepticism as of like, oh, is this an insurance salesman? Well, they put me in a policy called a LERP. Have you heard of it? No, because no one's heard of it. Okay, it is a very obscure, we'll talk about maybe there's times where this is suitable for somebody. It is a very obscure, like life insurance pseudo investment vehicle, okay? And what it is you basically just, you pump money into an insurance policy. It's a whole life insurance policy. And then you pay basically extra beyond the premiums, and the growth of the premiums invested within the life insurance, eventually that growth is then enough to pay its own premiums, and it kind of just grows cost-free. Very little of the downsides to this type of policy were explained to me. Let's be clear. What this policy is suitable for is somebody who is making so much money that they don't know what else to do with their money other than pay taxes. So the really only option available to them, because they've already maxed out their IRA, they've already maxed out their 401k, they've already maxed out their 529 plan for their beneficiaries' college. There's nowhere else to put money. So there's one last thing available to them. They can pump money into life insurance and grow money that way, and there's some tax-deferred savings within that vehicle. It is not suitable for someone who just got their full first-time job as a CPA making less than $60,000.
It's so painful.
So all I could put in was $500 a month, and I was told repeatedly over text, phone calls, everything. In 18 to 24 months, the policy will be able to cover its own premiums. The policy will be able to cover its own premiums. Cool, that sounds good. I was putting $500 a month into this policy. Well, I start wondering, like, where really is my money? How much is left? So I start making phone calls to kind of follow up on well, where's my money? I'll tell you where my money was. Gone. Because what was not explained to me from a LERP policy is that it's front loaded in the cost. So like you pay almost $500 a month in premiums, which if you've shopped life insurance, you know that that's an obscene amount. And so over the course of 5 to 10 years, my premium would go down because I front loaded them, or I've put so much money into the account that it paid all the premiums and now it's growing. That doesn't work when you're only putting $500 a month. That should have gone towards an IRA or a Roth IRA. And so I basically had to call, and he said, oh yeah, I totally forgot to call to follow up on your account. 2 years later, yeah, it's actually not going to pay for itself in 24 months. You're actually going to have to put money in for another 3 years. The cash value of the policy after 25 months at this point, so there was $12,500 that I put in, was less than $500. So the entire amount had gone towards fees. You know what amount went to him? Between, on average, a 60 to 80% commission of the value of premiums that I was putting in. Okay, so this is an example of someone who calls themselves a financial advisor.
Hold on, can we just sit on that for a second? Hold on. This is...
I need to keep talking, or I'm just going to say his name.
I just... That visual... this is another thing I want to point out is that guy called himself Brandon's friend. So that's the first thing I want to say. And if you consider yourself a friend, you don't do that to people. And then Brandon will dive into the how this all relates to what we're talking about today. But ultimately, he also reached out to that guy, and the guy kind of was like, "Yeah, my bad. Like, yeah, you're right. I kind of did put you." Isn't that what he said to you?
Exactly. And then his solution was, well, I can move you to a different LERP with a smaller premium amount, but you'll need to pay for another 5 to 10 years for it to become self-sufficient.
Yeah. So really just that visual, I want you guys to sit on that. That was somebody who was his friend and called him essentially a financial advisor. Okay. He was not a financial advisor. He was a salesman. Okay. Sorry. Go ahead now.
Yeah. No, that's exactly correct. So this is someone who... they're not a financial advisor. And the only reason they can call themselves a financial advisor is because financial advisor is not a regulated term.
Right.
There's no advisement going on. They're just going through a list of products because they can't advise. They aren't certified to advise. They legally can't trade stocks in your account because they're not an asset manager. They're not an advisor. But anybody can use that term because it's not regulated. So he basically presented to me completely disguised as financial advisement. Here is a list of life insurance, and this is the policy that's best for you, because the only policies presented to me was a list of life insurance policies. So maybe within the world of life insurance, that was the most suitable for me. But the bottom line is no 22-year-old with a $60,000 salary should be invested in life insurance policy. They should consider a term life insurance policy for life insurance reasons.
If they have dependents.
If they have dependents for $25 a month for 30 years, and then they should be investing in a Roth IRA or a 401k through their job or a traditional IRA, whatever they want to do. So, but this is, so this goes back to, and we've talked about a lot in our episode, of fiduciary. James would be sued for this, and I would win because there is no advisor, and feel free to challenge me on this. Talk to your advisor, talk to 5 advisors and say, there's a person, they're 22, they make $60,000 a year. Is a LRP the best investment policy option for that individual? Everyone will tell you no. It's a ridiculous proposal for somebody, okay? So a fiduciary would fail their fiduciary responsibility, okay? Someone who's just an insurance agent, they're set to the standard of suitability, and they can prove, and they did because I challenged it with the state board, this is a suitable recommendation. It is technically a legitimate investment option, and you chose it, so you're fine. They don't have to prove that it's the best thing for you because they're not a financial advisor. They're a salesman, but anybody can call themselves a financial advisor, okay? So that's the first category of person. Get insurance from an insurance broker. Get everything else from a legitimate financial advisor. Don't buy investment management from an insurance salesman.
So just to touch on that too, like I legally, or I mean, I guess in any capacity, I can sell insurance. I can sell health insurance. I can sell life insurance. I can sell disability insurance.
Let me just even jump in on that before you even continue. Why can you sell life insurance?
Because I took a test that I didn't study for, and I got a 60 out of 100.
What's the minimum you can get to sell life insurance?
Well, I got a 68 out of 100.
And you can get what?
A 60.
Yeah, 60% on an exam you studied at all for?
No, I didn't study at all. I didn't even open the book. So when you start out in this industry, and so I started at a really big firm, like a Fortune 100 firm in the S&P 500, and they're like, you need to get X, Y, and Z exam or series. There are exams you got to take: Series 7, Series 66, and you got to get your life and health insurance license. Okay, well, those first 2 exams are horrible. They'll ruin your life. There were like 60 interns when we started, and because of those 2 exams, there was only 6 when the testing period started. And when all of the internship was done, there was only 3 of us left. So that shows how much it weeds you out. It's not a really hard test, but there's so much information you have to really study. Obviously, in your early 20s, you don't study. But back to the life and health insurance thing, I can do life and health insurance. And I do think that there are, like, for example, physicians. They need disability insurance. I sell physicians disability insurance. Okay, but I do like a legitimate shop. Like, I'll shop 500 policies for a physician, and we decide on the one that's cost efficient, covers them the most, the way that they want, and gets everything that they want out of it. Okay, that aspect of insurance, though, outside of that, I hate insurance. I don't want to do it. I think it's, for most people, you don't need it. If you have dependents, you probably want to get life insurance, but you do not need life insurance. Life insurance is always sold to you as needed. It's a need.
And more importantly, because it's a need, it shouldn't be talked about in the world of financial advisor. It's not, oh, do you have a financial advisor doing insurance? No, insurance is like we all have car insurance, right? We don't get it through our financial advisor because it's not an investment strategy.
Right.
It's not how you're going to grow wealth. It's very important. A lot of people have insurance. If you're the only working member of a marriage and you have dependents, so there's only one person who the full income depends on, you should for sure have a life insurance policy.
That makes sense.
It's not an investment strategy, and the people who sell it are sure as hell not investment advisors. They're not. Well, they can call themselves whatever they want. My dad can call himself a financial advisor. He's not, okay? You need someone who actually is a fiduciary and does actual financial advisement based on a comprehensive review of your situation and the options available to you, and makes recommendations, or actually manages your account based on the recommendations that are the best for you.
Yes.
Let's move on to the next category.
We're angry about LRPs.
I think we've crapped on insurance salesmen enough. Look, insurance salesmen are great at selling insurance. This is not a drag on insurance salesmen in the industry of insurance.
Not at all.
But it's important to understand that they should not be, but too often are, putting themselves in the realm of investment management, and they don't belong in that category. They're not investment managers.
And real quick, I want to add this because I'm very transparent about fees. Like, I'm very fee conscious and fee sensitive. And that's because I started again at a really big company where it was push products, get the most amount of money you can. Otherwise you don't survive, which I'm like, oh, this is horrible. I feel gross. I feel disgusting because it's not moral. When you sell an insurance product, I'm going to say, I think the highest I've seen is 85. So the average is, or the range I would say is between 50 and 80% of whatever it is you're paying. So if you're paying annually, you're paying a fee to your insurance person, 50 to 80% of that premium goes to them. So they're significantly incentivized to sell you these products. Okay, 50 to 80%. Think about that. That is a lot. That is a lot of money. Okay, you get real motivated real quick to sell policies, even if they don't make sense. Okay.
And it's way less transparent because there's like the insurance salesmen don't have an ADV. They don't have an ADV that lists their exact fee structure, that lists every service they exactly offer to you. They sell you a product and they get a commission. So most of you won't know what the commission even is.
Yeah,
so,
the company pays them, but it comes from you still. But like, yeah, if you get an Aflac policy, I love Aflac, not talking bad about them. Aflac pays your advisor, or he's not an advisor, your insurance agent.
You've undermined everything I've built here.
Oh no. They pay them. So that's how you pay the company pays the insurance agent.
Okay, so now we're going to talk about the kind of categories where these people are legitimately different options for the type of advisor that you work with. The first we're going to talk about is broker-dealers or advisors that work with broker-dealers. And I'm going to send this straight to James. So, James, what is the difference in terms of your client experience if you're working with a broker-dealer as opposed to someone like us who's an RIA or an investment firm?
Yeah. Okay, so I also want to disclose real quick, just for visual purposes, this one, the broker-dealer relationship and the commission relationship segment that we just talked about, you can do both. And most people tend to do both, okay? So you can be a registered representative, which is an advisor through a broker-dealer, okay, which is probably, I would say, a majority of advisors. They're this hybrid they wear two caps is how it's described. So
and give an example of broker dealers that people have heard of, so they know who we're talking about.
Yeah, so like a broker dealer would be like LPL Financial, Securities America Financial, Osaic Financial. I'm trying to think of all of the different broker dealers. There's so many of them. Edward Jones is a broker dealer. There's so many. And you have an advisor who is, you call it, like, who do you broker through? Like, who is your relationship, right? So if you're a BD advisor, you're called a registered representative at Edward Jones, at Osaic, et cetera, et cetera. Now, the way that relationship works, and it depends, but they say they have two hats, okay? They have the suitable hat, which Brandon had discussed a little bit, and then they also have the fiduciary hat, which is the assets under management, actually giving you advice on your accounts. And guess what? They get to pick which hat to wear. Okay? So, if an annuity makes sense for Mrs. Jones, a widow who just retired, who now gets her husband's Social Security, right? That annuity, well, they can sell an annuity and they don't have to be a fiduciary in that capacity. But at the same time, if they're rolling over her 403B because she was a nurse, that has to be a fiduciary standard, right? They're rolling that over to a managed account. They get to pick and choose what hat to wear. And if it ever got to, court or however, arbitration, I think is the first step usually, that's easy to defend. All they have to say is, well, we were acting in a suitable capacity for the annuity.
So if you think about your initial meeting with them, like their initial recommendation does not have to be as a fiduciary.
None.
Correct. If you want to work under an assets under management model, now they are now serving as an AUM fee advisor. Correct. And they must be fiduciary in the trades they're recommending.
Correct.
But they don't have to be fiduciary, so to speak, in recommending that you even move to AUM, because they can instead sell you suitable products and then they never end up working for you as a fiduciary.
Yeah.
Okay.
So there is a new rule now at the SEC though and FINRA, that if you are a larger firm and you just tell someone, hey, we're going to move your company retirement account to an IRA, they have to be able to codify. They have to be able to codify and justify. So it means they have to write it down and keep track of it, that it was better than if you stayed in the 401k. And a lot of broker dealer advisors, registered representatives, are struggling with that because that's so much of their retainer business. Retainer meaning that they just get monthly income from that, is company retirement plan rollovers into an IRA. That for me takes me 5 minutes. It's almost always easy for me to justify it because I'm constantly working in a fiduciary standard and I can usually lower their expenses than what they're paying, but the registered representative can't. They can't lower their expenses. The 401k expenses tend to be very low in relationship or in comparison to a registered representative financial fee.
And a lot of times a broker-dealer or just an advisor in general, a lot of them use passive investment strategies. And so It's hard to justify a rollover from a 401k where a lot of your money's in mutual funds that you're not trading, and then just move over to an RIA managed by this broker-dealer or this advisor under a broker-dealer, and then they're just putting you in an index fund for 10 years and not trading either. So They're not providing value, except that now they're feeing your account.
Yeah,
so
now they're getting 1.25 or whatever it is that they're charging. Correct. Yeah.
So let's talk about now the next two categories, and both of them are an advisor is actively to some level they're managing your account, they're authorized to make trades in your account, they're actually managing your assets. The difference is, and a lot of people don't know this is happening, one of them is the wizard behind the curtain, okay, and the Wizard of Oz. One of them is up front with you. In both cases, an advisor is working with you, but in one of the cases, you don't know the advisor that is actually managing your money, okay? So the third type of advisor we're going to talk about, and they could be a RIA, they could be a registered investment advisor, but they're using what's called a TAMP, and that's called a turnkey asset management program. Now, a TAMP is your actual advisor in the sense of how you would think about it. Oh, I have a financial advisor managing my assets. A lot of people are saying that, and they don't realize that person you're talking about, Dave Smith. Dave Smith isn't managing your assets. Dave Smith pays you 50 bips, 0.5% to give charges you and to make recommendations and says this is what we would do. This is how we're going to do it. But the person making trades is a third party. They're called a TAMP. They're an asset management program that's actually trading in your account.
In San Francisco or London or Japan or Hong Kong.
And so you know what Dave does? He meets with you once a year and he pulls up your account 15 minutes before the meeting, and then he says, here's how you're doing. Do you want to make any changes? But guess what happens if you do want to make changes? He communicates that to a TAMP who makes the changes for you. Yeah. So you're basically just paying for two advisors with less transparency, when you could just be paying one advisor with full transparency. And we recently talked to a client who
this is painful too,
who we met with. Okay. And so, so they decided to use another advisor. At the point where they were ready to move over to the other advisor, it was still not at all transparently communicated to them that their advisor at this company used a TAMP. So they thought, oh, we like this advisor's, their philosophy and this company. Well, that company doesn't manage assets. So you go to their website, you scroll to the bottom, you look at their ADV. It's Part 2A, I believe, right?
Part 2B.
Part 2B, where they have to disclose fee structure, management style, and they disclose, their agreement or the wording of their agreement. You can see very clearly on the website. It says on their ADV, Part 2B, we have a turnkey asset manager, or they don't call it that, but we have a third party that manages the assets. Keep in mind that because of the use of this, sometimes the investment decisions made by that third party are not in line with the investor's risk tolerance that they've communicated to the advisor. They have to disclose that for you because they aren't managing your assets. So when they meet with you, they're hopefully communicating that to the TAMP who's actually trading. There could be a disconnect there because you're not meeting with the TAMP. You don't ever know your advisor. You won't ever meet with the advisor because it's not even one advisor. It's a company that's creating portfolios and is trading large. They're putting you in a basket. Hey, this is a 25-year-old with medium risk tolerance. Boom. They're in this basket. They're in this portfolio. They're not, your advisor is not actually doing what most people expect their advisor is doing, which is meeting with you quarterly or yearly, going over your goals, and then customizing your investment portfolio based on their goals. They're just communicating to you what they would do, and then somebody else is doing it. And so at the baseline, what that means is there's two fees. You're paying your advisor a fee, but also there are management fees being feed directly from your account to pay the TAMP, which is, James, how on average, what is that fee on top of your advisor fee?
Yeah, the lowest I've seen is 0.25%, and I've seen it all the way up to 1.1%. So that's a huge range. The client that the people that we spoke with specifically, this situation, they had millions of dollars. So you do the math on what you're paying someone who you've never met or spoken with or thought you were working with.
And the advisor is charging between 0.7 and 1%.
Right.
So you're already paying with that much money what you would expect an advisor to fee, but your advisor isn't managing the money, so there's another 50%, whatever it is, of your total fee, so 0.5% or whatever it is, from somebody else who's actually managing your money and you never speak to them.
And it's not counting the investment fee they're putting you in. So
right.
Now you have, and there's a platform fee in some situations, not always, but sometimes. So now you're paying a fee to be somewhere that you don't know, to be managed by someone you don't know, through someone you thought you knew. That is the visual I would give. And full transparency here, we didn't get that client. They ended up going with the other advisor, even though we showed them what we're telling you. They still said, hey, we want to go with them, which obviously to me is a huge blow to my ego. That I've been still thinking about that.
James doesn't take rejection well.
I don't take rejection well, especially when, first off, they interviewed many advisors. It was between us and them. But this is a good example of sometimes you could show people, that the ocean is blue and they'll still say it's red.
And the biggest thing here is the advantage of this structure is an advantage to the advisor, not really the client.
100%.
So it makes sense why these companies that use TAMPs can grow, and this is the sales pitch of TAMP. So again, this episode is all about transparency. It's about helping you as the client see things that you almost never see behind the curtain of the industry. We've been solicited by TAMPs. James could show you text, but you know what they're telling us? You don't have to worry about the assets anymore. It's going to free up so much of your time to meet more clients and talk to more clients.
Yep.
It sacrifices customization for each client in exchange for us tons of free time to get more clients. It doesn't help you.
Pass the fee. You don't have to take it out of your fee. Pass it on to the client. The client will pay the fee.
Yeah, it's only 0.25%. So you still get your full advisor fee. And we, we're great at what we do. Here's our historical performance. You get to talk to more clients. That doesn't help you. It doesn't help the client. But here's a kind of shocking thing. Right now, estimate 25% of advisors use TAMPs. Another 23% use some form of other third party. There's another advisor, there's an associated branch, whatever, actually managing assets. So on average, if you're working with an advisor, there's a near 50% chance they don't actually manage your money. And there's a good chance that if you haven't gone to their website, pulled up their ADV, and you know where to look and read through their 25-page ADV to find a one-paragraph section of, we use a third party, you'll never know. For 30 years, you'll think your advisor has managed your assets. They didn't. And you probably don't know that there's hidden fees in your account.
Look, I get it, right? I love it when someone meets with me, they love me for who I am, and they just trust me, okay? I love that. I'll be completely transparent with you guys. I am not the best. I don't have the best bedside manner. I don't. I'm not really happy. I don't send out birthday cards. It's not this great, lovely, loving, friendly environment. It's, hey, I'm going to do right by you. I'm going to be extremely diligent in your portfolio, and I'm going to know what's in your account, and I'm going to try and invest the way in accordance with your goals. these people, these advisors, they have excellent bedside manner. They're fun. They send you a birthday card. They send you a $10 Starbucks gift card at the end of the year, and they're laughing all the way to the bank at you guys. Okay? They're laughing at you. If you have a financial advisor and you don't know if he manages the money or if a TAMP does, that's on you. And I mean this, again, I don't have the best bedside manner, but you guys need to ask these questions. Hey, who was making the investment? Who is making the investment picks in my account? If I was you and I really wanted to find out, I would just show up at my advisor's office. Usually that's not allowed, right? It's appointment only, but I would show up with your printed statement. You should know what's in your account and just say, hey, what are the 3 biggest holdings in my account? Your advisor will not know. Okay. Now it's easy for me to say because we have roughly 70 clients that we manage assets for right now. And so I know what's in everybody's account. I can pretty much have a conversation without even looking, right? I know because I did all the investment picks, right? That's the kind of relationship you want with your advisor. All right. Now the way he'll, cover that up, he or she will cover that up is be like, oh, well, we're not stock pickers. We're not professional money managers. I think when I hear that answer, I get kind of angry because I think back to whenever I first started at the big company I was at, and the way they tell us to get clients is make a project 100, which is the 100 closest people in your life who would have a meeting with you. Like who would hear you out to manage their assets, okay? Horrible strategy, horrible. It's just disgusting. Well, the first person I thought of obviously are my parents, okay? I was like, okay, well, maybe my parents will meet with me. Well, my parents are both in the medical field. They've done a good job saving, okay? I remember going to my parents being like, hey, like, this is my job now. This is what we're doing. And my dad's first question is, well, why would I ever use you? I put all my money into index funds and, I get 10.5% every year. Like why would I pay an advisor to put me in stuff? And I struggled with that for 5 years. Okay. That question, why would I ever use you? And then I realized, well, someone would use me because I love this. I wake up at 4:30 in the morning and I look at financial statements and I wait for people's companies' quarterly reports. And I want to know what companies are giving out new dividends. I want to know the earnings per share. I'm in love with how companies grow and what makes a company great and trying to find what we call a 10-bagger, which is a company that has potential to 10x over the next 10 years. It's those kind of things that I think make me valuable, that I'm obsessed with learning about it and I want to be great at it. Well, these advisors can't answer that question. You know what they say to someone like my dad who says, why would I ever use you? They say, oh, you're not our ideal client then, which is another way of saying you're too smart. We don't want to use you. We want the dumb people. Okay. So these advisors who have great bedside manner and they're respectful and they send you a birthday card and a Starbucks card, they're laughing at you. They're laughing at you. All right. I'm done with my rant.
Are they all laughing? Is this categorically true? Is this a logical, true statement?
a lot of them, but not all of them.
Cool. So there's the first 3, and so this is really what we want you to understand. There's no section of how advisors operate that's intrinsically immoral. But there are massive opportunities for predatory practices, and you need to understand how your advisor works because then that allows you to have your ears perked up for recommendations that you go, yeah, that does kind of seem like the recommendation that would make my advisor the most money, right? If you're working for someone who works for an insurance company, look for things they're trying to get you in that are high initial investment because that probably means they're maximizing their commission. If you're working with a broker dealer, look for people who are trying to day trade in your account because they're making money on each individual brokerage transaction. If you're working with someone who works with a TAMP, look at someone who's really customer focused. Doesn't mean they're bad at their job. It means that, well, there's a risk here now that they're really focused on coming across good in the first impression because they're not really actively in my account and I'm paying for a service I'm not really receiving, okay? Now let's talk about the last category, and that's an RIA or an advisor who does their own investing. So that means they usually have a custodian. So that's someone like Schwab. That's who we use. Fidelity is one. What's the
Altruist.
Altruist is one that's kind of more popular. It's a little sleeker interface. You'll see some younger people really drawn to that, and advisors are moving there because a lot of their younger clients like using it. It's just very user friendly, pretty. It's easy to navigate, and honestly, it has a great interface. It's really good to use from a client perspective. So you see these custodians, and then the advisor basically has advisor account privilege on your account where they can make trades for you inside your account. So you maintain ownership. It's at a custodian for insurance and holding and all that type of stuff. And then the advisor is able to make trades on your behalf in line with your risk tolerance, so to speak. So this is how we operate. This is how a lot of independent advisors operate, where they manage your account. So if you talk to them, they're the ones who did the trade. They're the ones who are going to do the trade next week. They know what's in your account. There is generally the least amount of fees in this account because there isn't a broker-dealer. There isn't a TAMP. There's no one else taking money out. And if they have an active management style, if they're an active managing investment advisor, that generally means there's going to be less things like mutual funds and index funds that are long-term 5-10-year holds. Usually mutual funds is where there might be a little bit more fees in your account. Not that there aren't super cheap Fidelity mutual funds, but or Vanguard. But in general, long-term hold accounts, they might be in things like mutual funds that have external management within those funds themselves and therefore have fees within those accounts. So generally, this is going to be the least amount of fees for you as a client. In the interest of fairness, James, what are the disadvantages or risks people should be looking for if they work with someone like us who's an RIA? What are the disadvantages of working with an RIA who is the one managing the account? It's a one-stop shop. Your advisor does everything.
Okay, so the disadvantages, I would say, is that RIAs do tend to be small. That's probably the biggest one, meaning there isn't a lot of coverage for strange needs. So for example, say you have a bunch of real estate, right? And you're like, I want to get out of this. An RIA, now they're a fiduciary. They'll tell you they can't help you, but they're not going to be able to help you with that. They're going to be very specific, and most likely it's going to be like retirement planning is what a lot of RIAs do. They have niches. Okay, that's the number one thing. If you need like expert financial advising in a specific scenario, RIAs probably, not always, but a majority of them are in the retirement only field. And the reason for that is because it's easy. It's very easy to take a 401k from someone, their job, roll it into an IRA, and then pay them $600 a month. It's very easy for us to do that. But when you get into estate level planning and charitable giving and all of these crazy things, RIAs aren't always the best avenue to go. The other negative I would say is that it has to do with the one-man shop also. So right now it's just me doing the investment picking, which works because we're small enough, right? An average advisor at an RIA might have 700 clients, 800 clients. That's hard for an advisor to really know what's in everybody's account, right? And at that point, you tend to get portfolio. So like you have a growth portfolio, a conservative portfolio, moderate, etc. And you sort of say, hey, look, this is how I operate. If you want to work with me, you have to fit into one of these portfolios. So that is the other negative, is that if you really want someone to know what's inside your portfolio, it's difficult for a small shop to be able to do that. So they tend to outsource that or not be able to work with you, is what I would say. Those are the two big negatives.
And what would be some of what beyond the lower fees, kind of what does someone get from an RIA that makes that an attractive option?
Well, I mean, it's the term fiduciary too, is that it has to be. A lot of people aren't RIAs because they're not capable of taking on the responsibility of what that means. When you're an RIA, you have to know not only what's a good investment, but what are bad investments. And that's because when someone comes to you and they're like, hey, I'm in X, Y, and Z, you need to be able to know pretty much immediately, oh, that is not something that's good for this person. That is not the best interest. This is not an investment that's in the very best interest of the client. But when you work with an RIA, the only things we recommend fit your goals. And usually when we work with people, it's, hey, you have option 1, option 2, option 3. Okay, that's usually the capacity. And then the client says, I kind of like option 1. What's your recommendation? And then we'll say, hey, we think option 3 is the best because you get a little bit of both, best of both worlds. It accomplishes X, Y, and Z goals while not suffering in, ABC category, etc. So the number one benefit, I think, is just the fact that you can rest assured that legally they're bound to do right by you. Also, economically, fiscally, they're incentivized because they want to get paid. As you do better, they want to do better.
And if they make bad choices, you're not referring anybody to them,
right?
So they really, it's just us. We don't have an Edwards Jones funnel of leads that we try to close on. We don't have a, marketing strategy where we have this huge lead program and we just talk to 200 people or we're cold calling and hopefully we land 5 of them, right? We need to do right by our clients in addition to our want to do right by our clients because we need to build a reputation that keeps our business afloat. So there's a lot of pressure that comes with that. And I can tell you there's a lot of nights where James doesn't seem like he sleeps a whole lot the night before because there's a lot of market changes and he knows he has, quarterly calls with clients and he wants to make sure that he knows their answers to all those questions. So it does come with a lot of pressure. We think that we operate that way because we believe that those pressures are the most healthy. There's pros and cons, but the pressure to do good performance is a healthier pressure overall, in our opinion, than the pressure to get high commissions or to get, kickbacks or to get, high, for a broker dealer, high brokerage transactions in day trading. So we think that it's the healthy incentive, not that it doesn't come with risks, that there are advisors who are RIAs who are doing bad things. But we believe that overall it's the healthiest structure that gives us the most incentive to do the best and is the least perverse, I guess, of all of the kind of danger red flags that advisors can fall into because of the incentives that they have doing X, Y, or Z for their client.
And just to give a visual here, so we get to everything that I want to do, I get to do, right? Me and Brandon are in charge. There's no one ahead of us telling us how we have to charge, what we have to sell. We have open architecture in what we decide to recommend or invest in with clients. Now, the other thing that's really big, and I've only ever done this once, but we can choose how we fee people. So, for example, I had a client who I put him into an investment, which at the time was killing it, but immediately it went down because it was at the all-time high for that investment. And I felt horrible. And no, I didn't lose him a lot of money because we didn't sell. We stayed in it. The money came back. He eventually was in the green, way more than if he would have done, a balanced fund or any other investment option. But for the time being, that volatility, it was like, ooh, you come on board and then your money drops significantly. I say, hey, look, I'm not going to fee you. Okay. I just don't feel good about it. We didn't really provide you any value. Now, I might get that back later on if it's in the green. And he was, he was a blue collar guy. He was like, I really respect that. I appreciate that. Like, we're going to stick with you. We're going to trust you. We're going to ride the wave out. And then he had significantly more money. So that, in the aspect of just we have control, like we get to operate as a small business where a lot of these places don't. It's kind of like, oh, well, sorry, you paid for a LERP. Like, you're not seeing your money again. There just isn't there isn't the personal touch to it. I guess a way I would describe it is, this is how I like to describe it to clients. You get our cell phone numbers, right? You don't get a 1-800 or some office where there's a operator, then there's an assistant, and then you got to hear back from your person. You get our cell phone numbers, and it's that relational aspect to the RIA that I think is super valuable. Nothing matters more to people than their health and their wealth. Okay. And that encapsulates your family, your personal self, all of that, your health and your wealth, the health of your family and you, and the wealth of your family and you. And I think RIAs do a really good job of equating that intimacy into the value that they provide.
Yeah, and I think that's a good example because it also shows that kind of relationship there where if the advisor you're working with is also the advisor who is the one authorized to make trades in your account, you can set up that phone call to say, hey, temperature check. This is the investment we did. It's down. We do think it will rebound, but obviously we understand why you might be nervous. How are we feeling? Has our risk tolerance changed? We do still think it's a good long-term investment. It is down right now. Do you want to come out? We don't recommend it, but we can get out, use a little bit of a capital loss to offset gains for your taxes, and we can put in something that's growing better that we think is the best investment now. So you can have that continually changing risk tolerance, investment preference to constantly react and make sure the client understands what's happening with your investments and is still okay with the strategy employed. And at any time you can change strategies and your RIA will make adjustments to fit your needs.
So on that exact note, say you have that conversation with someone at a registered representative for a broker-dealer, an advisor, or you go to an RIA that uses a TAMP and you have that exact same conversation. And you go, what the heck? I'm down 10%. Like, we just got into this. You told me this was going to be, in the short term, really great for me. Their answer is going to be defensive, meaning they're going to say, whoa. Remember, I'm not a stock picker. That's the investment manager's job. Like, let's look at what they're doing and we'll see if we need to pick a new investment manager. They're not saying, oh, I know exactly why X, Y, and Z did 1, 2, 3. They're not saying that. They're getting defensive. Okay. I mean, think about what you want. For me, it's clear. I want to know who I speak to makes the decisions in my account. And what they'll tell you is they manage the managers. That's what they'll tell you. They'll say, oh, we're the offensive coordinator and we know who the quarterback is and we know who the running back is and the tight end, but we don't actually score the touchdowns. What? That sounds so stupid to me. All right, I'm done ranting. Go on.
Don't hate the player, hate the game.
Oh,
Market goes up and down.
Yep,
this is what you signed up for.
There's no responsibility.
We can't predict the stock market, So and we can't. But the ability to adapt and the ability to communicate to clients why the decision happened and whether or not it's still the best option, that level of communication with where your money is, that should be happening with your advisor. And that's why we operate the way we do and why generally you're going to have more of that understanding by working with the person who's actually working with your investments. Well, that's all the topic we wanted to cover today. It's comprehensive. It goes a lot in, and it exposes a lot of the things about how we and everybody else operates. And that's really the whole point of this podcast is let's give people the tools to understand investing themselves and to learn and to empower them, not to just use a lot of big buzzwords that make us sound smart and then hopefully, clients come to us. So that's a lot of some kind of interesting things about the industry, some kind of dirty things about the industry. Big takeaway here. You need to know what all the fees are. Who's managing the money? How many different people are you paying fees to? What are those fees?
Hands in the pot.
And you need to make sure that you're working with a fiduciary, okay? Not someone who's selling you products, not someone who is entitled to create large commissions because they can meet the very low standard of suitability. Work with a fiduciary who not only wants to, but is required to, by law, do the best thing for your specific situation. That's the truth of the matter. It's the thing we'll continue to harp on in every episode. Work with fiduciaries, but also hopefully this episode gives you a lot of tools to understand where your money is and how it's managed that helps you understand if you are working with someone who's doing a good job and is a fiduciary.
So just on that with the fiduciary stuff, again, like he said, we're going to harp on that. Fiduciary. Get it in your head. When you speak to people who are quote unquote fiduciaries, you need to not just say, hey, are you a fiduciary? Because what they'll say is, I work in a fiduciary capacity. That's not what you want. You want someone who is a fiduciary, okay? You want someone who is one. Do not get roped in and smooth talked into, I work in a fiduciary capacity. It's not what you want. You want someone who is a fiduciary.
Someone who's required to only do what they can do best and to do within that the best thing for you. Don't hire James to do your taxes. That's going to be a bloodbath.
That's going to be bad.
Okay, hire me to do your taxes. Don't hire me to manage your money. Hire James to manage your money, all right? Everybody should be hired for their best capacity. Get an insurance person for your insurance product, okay? Get a CPA to do your taxes. Get an RIA without a TAMP to do your investments who understands how to manage money. So you should be having people who are working for you, who are managing your money, everybody in their best capacity. That's what you really need to be looking for. All right. Well, as always, please send us questions that we can answer in future episodes. Please give us ideas for topics for future episodes. We would love to talk to you. If you want to do a free portfolio review, just see how you're doing, get an opinion whether you want to work with us or not. We love those conversations where we can just talk to you and let you know how we think you're doing. And we'll end on this note that we always do. Invest early.
Invest often.
See you next time.